After the Great Financial Crisis, regulated banks largely abandoned middle-market corporate lending. They left a massive credit vacuum, and something new had to fill it. That replacement was private credit. Since 2008, this largely unregulated market has swollen from roughly $300 billion to an astounding $1.8 trillion. For 17 years, interest rates were pinned to the floor, and loss rates stayed historically low. But as investor Steve Eisman recently warned, there is no doubt in his mind that a credit cycle is finally emerging. He argues an entire generation of private credit executives have mistaken a structurally benign economic environment for their own personal underwriting genius. Unlike publicly traded bonds, private credit loans aren't priced by an open market. The funds grade their own homework. They set their own net asset values, allowing them to report a pristine headline default rate of around 2%. But when you factor in borrowers deferring cash interest or negotiating quiet restructurings, the true distress rate is likely 2 to 3 times higher. The current stability is largely a product of accounting flexibility. The warning signs of a credit cycle exist, but industry opacity keeps the alarm bells muted. This chart shows a massive spike in contractual debt maturities clustered specifically around 2027 and 2028. These loans were written when money was cheap. Now they are hurtling toward a wall where they must be refinanced at today's punishingly high interest rates. Looking closer at these maturities reveals a severe hazard. Approximately 25% of all direct lending funded the buyouts of traditional software companies. These are legacy businesses now facing intense, cheaper disruption from artificial intelligence. The industry knows this is a vulnerability. According to a Wall Street Journal investigation, major funds have been actively massaging their sector classifications to hide it. If a vulnerable software company builds tools for hospitals, the fund conveniently recategorizes the debt as a healthcare loan. This split chart compares the numbers side by side. You can see the self-reported software exposure for industry giants like Blue Owl and Blackstone sitting well below their actual assessed exposure. They are systematically minimizing their biggest risk on paper. Traditional banks see the threat. JP Morgan is already marking down software loans in its portfolios and sharply restricting new lending to the sector. Meanwhile, the private credit funds holding identical loans continue to carry them at full value. They are marching straight toward a wall of high interest rates, holding billions in debt tied to a highly threatened sector, while acting as if the collateral is completely secure. Pacing speeds up slightly. To keep the machine growing, private credit eventually exhausted the pool of institutional money and then turned to everyday retail investors. They sold to brokerage clients and 401k plans, promising high yields and quarterly liquidity. But that liquidity comes with a strict mechanical friction called gating. To prevent a bank run, these retail-facing funds cap withdrawals at 5 to 7% of their net asset value per quarter. Recently, major vehicles like the Cliffwater Corporate Lending Fund and Blackstone's $82 billion BCRID hit these limits. When investor withdrawal requests exceeded the caps, the funds simply denied the excess redemptions. To suppress the panic and maintain the illusion of seamless liquidity, some private equity sponsors have quietly injected hundreds of millions of dollars of their own firm's capital just to pay out those retail withdrawals. It is an expensive, temporary fix. The promise that retail investors could easily access their cash was a mirage. Once those gates drop and withdrawals are denied, the resulting loss of trust permanently chokes off the retail pipeline. The retail panic is highly visible, but a much larger, deeply hidden risk sits within the institutional market: private equity's aggressive takeover of the life insurance industry. Take Apollo and the life insurer Athene. In this circular ecosystem, the private equity firm originates complex, illiquid debt and then turns around and sells that same paper to a life insurance company it effectively controls. This flowchart illustrates how they artificially boost leverage through captive reinsurance. The parent insurance company transfers these liabilities down to a severely underfunded shell affiliate. The parent claims a massive reduction in its regulatory requirements, a reserve credit, even though the actual financial risk hasn't left the corporate family. To make matters worse, these shell entities are aggressively relocated to offshore jurisdictions like Bermuda or the Cayman Islands. Once offshore, they are no longer required to file public financial statements, entirely blinding U.S. state regulators to their internal balance sheets. The massive leverage funding the private credit boom isn't trading on open exchanges. It is buried in offshore black boxes, backing the life savings and annuities of everyday policyholders with risky, illiquid corporate loans. Institutional defenders are quick to point out that this is not a repeat of 2008. The vast majority of private credit is locked up in long-term, closed-end drawdown funds. Investors contractually cannot demand their money back tomorrow, meaning an overnight systemic bank run is structurally impossible. Furthermore, the architecture is entirely different. There are no massive securitization chains or layers of CDOs, multiplying the losses across the entire global financial system in a matter of hours. But avoiding a sudden overnight crash does not mean avoiding a crisis. It merely stretches the timeline. The damage will arrive on a delay. When the cycle turns, the losses will move through slow-acting transmission channels. Retail investors will find their money stranded behind permanent withdrawal gates. Major pension funds will face severe cash flow freezes as distributions halt, and life insurers will suddenly discover their opaque offshore reserves are dreadfully underfunded. Ultimately, the real casualty here is the narrative of the illiquidity premium itself. The bill for $1.8 trillion of hidden risk won't come due in a single day of panic. Instead, it will act as a multi-year silent drain on the broader economy, exacting its toll slowly as all that structural rot is finally marked to market.